There we go. So, thank you guys for coming along this afternoon. We're joined by Ronnie Dodd from HMA Tax, who are a Scottish Agritourism member. And I'm going to let Ronnie go ahead and introduce himself and introduce the business because I'm sure he knows a lot more about this than I do. I'll moderate throughout and pick up if there's any questions in the chat. And we will have some time for questions and answers at the end, I assume, as well, Ronnie. So
Yes, of
I'll just
course.
let you
Yeah, yeah.
take it away.
I can put you on the spot there and ask you questions about the company just to see what your knowledge is. But no, listen, that's fine. I appreciate the introduction as well. What I'm going to do is I'll share some slides that we can run through as a presentation, and then at the end we can have a Q&A. And my details are on the slides as well. So if anyone has any questions that either they don't want to ask while in a sort of public group or they've thought about it afterwards, then please by all means reach out. So let me just see if I can share this. So, $64,000 question just before you stay off mic. Laura, can you see my screen okay? Is that fine? Perfect.
Yes.
Ideal. Okay, so to introduce myself and the company that I work for, obviously my name's Ronnie Dodd. I'm one of the claims specialists for HMA Tax. HMA Tax are a capital allowance tax relief specialist, quite a niche area, but that's an area where you can gain tax relief if you own commercial property. And it's all to do with the content of the building that you own, plus any investments that you have made within it since you've acquired it. So, as I say, capital allowances is something that came out from HMRC in 2001. HMA Tax was founded just over 10 years ago. We had our 10th anniversary last year. And it's founded by a couple of directors, Duncan and Tom. But it has grown from 2014 to now to be the market leader as far as capital allowance is concerned. And it is by quite some distance. A couple of years ago, we were taken over or bought out by an organization called K3. I call them the big dark overlord, but I don't know if that's appropriate, especially seeing that it's being recorded. But they have about a dozen different companies within their portfolio, but ourselves, as I say, very niche sort of tax relief for commercial properties. We've got Quantuma in there who deal with companies that go into insolvency and liquidation. We've got K3 Tax that helps with people for property transactions, so sort of stamp duty, additional dwelling supplements, and so on, and any reliefs that are entitled there. And we've all got our different areas where we can help and assist. So if you do have an inquiry specific about tax that's not necessarily related to capital allowances, please still by all means reach out because there's probably someone within the portfolio that we could introduce you to and they'd be able to help. The head office is based just south of Birmingham at Worcester or Worcester. And because of that, because the head office is south of the border, we have the accreditations ICAEW, which is the Institute of Chartered Accountants for England and Wales, specifically because they're based south of the border, but it covers the whole of the UK. And we have all the sort of certificates and so on as far as the accountants and the chartered surveyors that we work with. We have 100% success record with HMRC. We have submitted just shy of 9,000 claims now, and as I say, 100% success record. So it's quite a nice accolade to have, and we're quite proud of it. But yeah, that's the introduction to the company. So capital allowances itself, it's as I say, came out from HMRC 2001, and it's a tax relief for people that own commercial properties. Commercial properties can be anything from warehousing to care homes, from pubs and restaurants. And in this case, and obviously the reason we're speaking to yourself, the agricultural sector, if you have a farm or if you have a small holding or so on, that's classified as a commercial property. We need to remove the the farmhouse, because that would be classified as residential, but the majority of the land that you owned, commercial property, and the buildings and so on that are on it will qualify for capital allowance relief. It's a massively underutilized relief, and I think it's because HMRC don't actively promote the fact that the relief is there. As I say, it's been going for 24 years now, but HMRC aren't going to actively promote relief where you don't have to pay them as much tax as you would do if you didn't know about it. So as I say, underutilized, and as the screen says, less than 20% of people within the UK have actually taken advantage of it. So there's a box ticking exercise that you need to go through. So when you're complete, or when we are completing the claim on your behalf, we need to go through a bit of due diligence and so on, just to make sure that you do qualify for the tax relief. In terms of the property itself, it can be owned by an individual, it can be owned by a husband and wife, a partnership, limited company. It doesn't really matter so long as there is that sort of ownership there that we can then turn around and say, right, it's going to be owned by individuals or a partnership, therefore the tax relief will be applicable to the individual. Or if it's owned by a limited company, it's going to reduce the company's corporation tax. So depending how the property is owned will depend how the tax relief will get laid down. You have to be paying tax, which is kind of understandable. It is a tax relief. So if you're not paying tax, or if you're paying a very small amount of tax, it might not be worthwhile processing a capital allowance claim. But so long as you are paying tax and you do own the property, then it, but you should be eligible. As I say, we've got a team that sit and do the due diligence just to make sure that you would qualify. Property can't sit in a pension. Um, and you need to have claimed or sorry, you can't have claimed your capital allowances already. It's a one-off thing for the content of the building, and once it's claimed, it's claimed. HMRC get a bit twitchy if you try and claim the same pound twice from them. The only time that you can do a secondary claim is if you've made any investment in the property, capital investment, since you've purchased it or since you've inherited it, which might be quite relevant as far as the agricultural sector is concerned. That capital investment is quite relevant for agritourism because it's about farm diversification. It's about moving away from the main core revenue streams that you've naturally been using over the course of 5, 10, 20 years, and you're breaking out into different sectors. In order to do that, you'll obviously have to have invested into the property, which will allow you to top up a capital allowance claim because there is that capital investment there. So the way we work it out, capital allowances is a relief from when you purchased the property or you inherited the property. So we look at the value at transaction, and there's a percentage of that value that we'll be able to reclaim back. Depending on the type of property that you own, will vary the amount of percentage that we'll be able to recoup. So if you think about it, if it's a warehouse, then that's just the skin of a building. So the content of it is less than if it was a furnished holiday let or a holiday home or a care home or a hotel where the content of the building is a lot denser, therefore there's a lot more qualifying content there. It can range from 10% through to about 35%. 35% is very specialist care homes. Standard agriculture is normally in the region of about 20%, and furnished holiday lets, because if a lot of farms have sort of Airbnb style lets or these types of units, then we can claim about 25% of that purchase property value. For any investment that you make into the property, we can claim back anything from 40 to 55%. So it's a higher percentage for that capital investment once you've acquired the property. But again, as I say, it will vary depending on the type of property. Because if we're looking at a farm, if someone comes to us and says, listen, could you do a bit of due diligence and have a look at our farm? The barns and so on will have a lower percentage. compared to possibly having some furnished holiday lets there. I had one coming on board from just outside Edinburgh, and they diversified to making their own mozzarella. So they created a white room, and they also had a couple of barns converted into sort of storage and warehousing and so on. So the white room qualified at a much higher percentage, the barns qualified at a lower percentage, but they all kind of balance themselves out. And again, with ourselves, very transparent process. We'll sit and talk our way through it and keep you aware of the different values as and when surveyors visit, and we can unfold it all. So bit of a case study to give you an insight into what we've done with other properties. As I say, we're members of many different groups, obviously Scottish Agritourism, but Cumbria Chamber of Commerce, Visit Cairngorms, the Association of Scottish Self-Caterers, which it was Fiona from there that very kindly introduced me to the Scottish Agritourism. But Cumbria Chamber of Commerce introduced to a Cumbrian farm. They signed up, came on board, and this is a sort of slide that will give you the figures of how it unfolded. So purchased in February 2014, purchase price of 600,000. So that's the sort of base units that we'll initially work from. That's 600,000. A farm, about 20%. I think we qualified it was either 21 or 22% that we managed to qualify this one for. So the embedded allowances, which is the allowances that we qualified when you purchase it, we managed to get 127,500. Since they've bought it, they've diversified and they've invested £120,000 into it. We qualified that at 40%, that being 48,000. That gives you the total capital allowances of £175,500. Now, you don't get that as a sort of check or a bag of money or anything. You get the tax relief from that value. So in this case, the farm is 40% taxpayer. So the tax relief that we generated from that 100 or just over 175,000 was £70,000, well, £70,200. They had a couple of years tax rebate because it was the ability to recoup previous years that they had paid tax. We can look back to as far as 2 financial years, and the rest of it then just sat as credit on their account. There's no expiry date on it. It just gets used up as and when your tax liability is due. As I say, farm 600,000 invested, or 600,000 purchased, 120,000 invested post-purchase, and that has generated £70,000 worth of tax relief. So it is a very worthwhile process to go through. And the way we have our business model set up, I think they call it a success-based business model. But basically, we've created an environment where people can come to us and say, this is a specific property, or this is our property portfolio. We can have a look at it. Whatever qualifies, great, we can help and we can unlock the tax relief for them. Whatever doesn't qualify, doesn't cost you a penny. We have a look at it, and if there's nothing that we can help with, we just sort of shake hands and move on to the next one. So it just means that people can come forward and say, look, can you have a look at this one? And they don't have the risk of upfront costs or cancellation fees or any of that nonsense that can appear. So, and we take care of it all for you. There's also, we have insurances, public liability insurance, all the different things that you would want. If HMRC ever asked a question, we are going to answer it on your behalf, keep you in the loop with it, make you aware of what's happening, but it's on our shoulders to look after any questions that would potentially come forward from HMRC. But they're very rare. As I say, we've done just shy of 9,000 claims. We've been challenged 3 times. One of them was a Scottish estate, which was quite complex because it had hydro schemes and so on in it. But all 3 of them, we provided the commentary that they required, and they were all fine and they all went through. And I think after being challenged a couple of times, HMRC just turned around and went, "Do you know what? These people know what they're talking about. They're being able to provide when we ask, and effectively we've just been left alone since then." So, but yeah, so So common questions that we get asked a lot. The first one we get asked pretty much every single time that we're speaking to a client, and that is, hasn't my accountant claimed this already? Now, accountants, we're certainly not taking work away from accountants. This isn't a sort of pitch to try and poach business away from anyone. Accountants will be aware of this. They will understand how it works. However, it's very niche. It's quite a technical process to go through. You need a surveyor to come out and visit the property to have a look round to identify what qualifies, and as I say, report writing and so on. So accountants will be aware of it. Some of the, we call them the top four, some of the really big accountant practices will have a capital allowance in-house team that will look after it all, but they are people that will be looking after the likes of sort of Vodafone and Apple and so on. When it comes down to just sort of standard accountancy practice, they'll be aware of it, but as I say, it's a specialist like ourselves that will be able to maximize the amount you're able to get and ultimately unlock it all for you. So, in terms of your eligibility, a lot of people, especially in the agricultural sector, because they will have inherited farms, it will be passed on from generation to generation. There's always the question, does it matter when the property was purchased or property was acquired? It doesn't. The only challenge that we've got is the older the property is, the lower we assume the purchase price is going to be. Because if you bought a house in the 1970s, compared to buying it in 2024 or 2025, then there's probably an extra zero on the end of the purchase price in 2024, 25. So the older it is, the lower the purchase price normally is, or the acquired price. And that's what we have to base our capital allowance calculation on. But again, due diligence, we go through it with you. If it gets to the point where we turn around and say, do you know what, it's just not worth for you or for us, we just shake hands and move on to the next one, you know. So one of the other ones, and I don't know if it's too relevant because farms aren't sold off. Well, they are, but not as much as sort of warehousing and retail and so on. There's a thing called capital gains tax. If you buy a property and then sell a property, the difference in price, so if you buy at a lower price than you sell it, you are eligible for the tax on the difference between the two prices. And it's whether or not your capital allowance claim would affect that. And it doesn't, it's something that's completely separate. It is just a relief that's there because you've acquired property or because you've invested in property. But again, it's another one. I think it's more sort of the hospitality sector that it would be relevant to, but just it's on the slide, so it's worth mentioning. Um, and I'm trying to keep it as short as possible. That's basically it. One of the points that I would highlight, especially with farm diversification, is if you have Airbnb furnished holiday let self-catering units. As I say, we can qualify them 25%, we can get them all processed through. There was a change in the ruling from HMRC on the 5th of April of this year, saying that you can no longer claim capital allowances on furnished holiday lets. They're effectively moving them from what is a commercial venture into residential. With that in mind, if they're owned on a personal basis or husband and wife, or it's owned personally instead of in a limited company, we have up until the 31st of January 2026, as in 6 weeks away, to be able to get your claim processed for any furnished holiday lets. Our process will take 4 to 6 weeks. We are staring down the barrel of Christmas. So we are right up against it in terms of the furnished holiday, let's say. The rest of it, I don't need to rest on your laurels, but we can book it in January, we can get it all processed through and so on. But for those that own furnished holiday lets, if you're wanting to make a claim, it has to be done as soon as possible because we, and any company, it's not just ourselves, but any company needs that time to write reports, share drafts with you, get a surveyor out, and get it submitted to HMRC before that cut-off of the 31st of January. And if we miss that, you miss your tax relief for it. And unfortunately, it's not something we're able to retrospectively amend. So without putting any pressure, because this isn't a sort of pressured sales pitch. I don't have a pinstripe suit on, but if it is of interest, then please by all means get in contact. As I say, my details are there. Simple email, simple phone call, and we can run through it. I can find out if you qualify. If you do, great. And if not, as I say, it's not going to cost anything, um, so that's it. I mean, the next slide just shows the offices that we've got. We are throughout the world. We've got offices in Singapore, Dubai, over in America, and so on. Head office down in Ormsley, which is close to Kidderminster, near Worcester. And as I say, I look after the office up in Glasgow. I'll come off share now and just open up to see if there is any questions. Let me see if I can do this.
That was great. Thank you, Ronnie.
There we go.
So everybody got any
Did that all make,
questions?
yeah, I was going to say, did that all make sense? I've got a tendency to start to waffle on and I try and keep myself reined in as much as possible. I always joke and say if I ever want my kids to go to sleep at night, I just tell them what I do for a living.
Mhm.
So is there any questions? Has anyone got anything they'd like to bring to the table?
Mm, Caroline?
Yeah, hi Ronnie.
Hi there.
It's a question about, so you're talking about holiday lets, and I probably didn't follow you properly, but whether they're commercial or they're domestic. And there's a big talk at the moment about rates and commercial rates and private and business rates and property rates on holiday lets on farms, etc. So
Yes. Yep.
how does, if you've got a property that's a holiday let on not a non-commercial rate banding, and you go and get commercial tax relief on it, how do the two sit together? How do you not shoot yourself
The-
in the foot by doing
yes, no,
one thing and not the
absolutely.
other?
The two of them are actually very separate from each other. The business rates and so on is almost a separate entity altogether compared to the tax relief. What when we're processing a furnished holiday let through, we need to demonstrate to HMRC that it is being run as a furnished holiday let, and it's not just someone that's bought a second home and they're trying to hoodwink HMRC to try and get some tax relief from it. So to identify it as a qualifying furnished holiday let, it has to have been advertised for a minimum of 210 days of the year. It has to be let for a minimum of 105 days of a year, and it needs to have previously been residential. So long as you bought it as a house or you built it as just a cottage or so on, and then started operating it as a furnished holiday let, that will not affect whether you are on domestic rates, whether you're on commercial rates, whether you have a license or not. All we're doing is demonstrating to HMRC that the property is being used for, in this case, a commercial purpose where you're running it as a furnished holiday let. The rates and so on, I know it's a very hot topic with the ASSC at the moment, and Fiona, she's got the bit between her teeth for them, which is great, but they are completely separate entities altogether, which um, it is good for ourselves because we don't necessarily get involved in that area. But all we need to do is just demonstrate to HMRC that the properties are being run as holiday lets instead of, as I say, someone just buying a secondary property and just trying to get some tax relief when they're not necessarily entitled to it.
Okay, so and on from that, do you have to, supposing you did buy a neighbouring property and you were a farmer and you wanted to then put as a holiday let, do you actually have to live in it for a spell before
No,
you can do
no,
that?
not at all. Just so long as it wasn't previously being run as a holiday let. You don't necessarily have to have stayed in a property. It could be an additional dwelling. It doesn't have to be a main residence that you then convert into a holiday let. The only thing that, and again, something that I forgot to mention, we have to demonstrate that the property was being run as a furnished holiday let prior to the change on the 5th of April 2025. So the 5th of April of this year, so long as you were operating before then great. If you started operating your holiday let post 5th of April 25, then unfortunately it just doesn't qualify. HMRC have that sort of stake in the sand that it has to have been operating beforehand. The best thing, and my advice, not just for yourself, Caroline, but as I say, the way that we've got it set up, it's that sort of risk-free analysis initially. Let us have a look at it. We'll do a bit of due diligence in the background, and if it does qualify, great. And as I say, if it doesn't, it's risk-free. It's not going to cost you anything, you know. Perfect.
Thank you.
Okay.
There's a couple of questions in the chat. So Lynn's asked, what about the buildings that have been purpose-built and only have planning permission for self-catering let, but don't meet the timing parameters you've just set out?
The timing parameters, as in if they haven't been operating prior to the 5th of April, this is obviously quite a relevant date. If it's not been operating prior to the 5th, then
no, Ronnie, sorry if I can just interrupt. No, that
yes, of course.
Timing parameters. It was when you were saying it had to be advertised for a certain length of time, which we meet, but the property hasn't been rented out for the number of nights, the minimum number of nights, not from it not being advertised. We just haven't had the bookings.
So there is a bit of flexibility as far as the 105 days are concerned, so long as we can demonstrate that you're trying, and it could be for many factors that you've not managed to fill the property. We've got the joys of COVID that obviously there's still the hangover from COVID, which allows us to demonstrate that you've been trying to fill the rooms. I think for the 105 days that you have to have it filled, if you only filled it for 20 days of the year, for example, you'll probably have that rejected. But if you got to sort of 70 or 80, please don't quote me these figures, but if you can show that you've really been trying to get it filled, you have been advertising it over the course of the year, then we've got grounds to be able to get that process through. Yeah. And again, my advice is let us have a look at it, and it's something that we need to act on quite quickly. So off the back of this, as I say, my email address, very simply, ronnie@hma.tax. Please just drop me a quick note. I can give you a call, we can run through it, and if it does qualify, it just means that we can get the ball rolling so that it will be done before the 31st of January. So
okay, thanks.
Okay.
There's another question just underneath from Neil. He's asking if an STL is sold, presumably CGT relief can be claimed on improvements. If capital allowances have been claimed, can you then claim CGT relief? I don't understand that from maybe you do.
CGT, capital gains tax. You can, just because you're claiming capital allowances on the capital investment, it doesn't affect the capital gains calculations. Obviously, the property will be valued at the point of purchase, and it will also be valued at the point of sale. And it's the difference between that, which is what capital gains tax is worked out on. The investment, the capital investment into your property won't impact or affect the capital gains tax at all. So, yeah, as I say, it's something that a lot of people think because they're effectively claiming money back out from HMRC, it's going to have some sort of impact. But albeit they are all, if you had a Venn diagram, there would be a bit of overlap between them all, but they are separate entities in terms of your reliefs or liabilities are concerned. So, yeah.
That answer the question for you, Neil?
Yes, that's fine, Laura. Yeah.
Any other questions? Sorry.
No, I was going to just say if there's questions where you're not comfortable at coming forward in a group setting, then you can ping me an email and I can come back. And again, similar to Neil or to anyone else, if they have questions and they would like the sort of direct links from the HMRC website that will explain other than just having someone like myself coming on saying, oh, listen, no, it's going to be fine, don't worry about it. And then it sort of bites you in your bum at a later point. If you want, you can drop me an email and I can send and furnish you with the information that is direct from source so that you have that and you've got the confidence that doing this isn't going to impact something later on down the line, you know.
Just popped your email address in the chat there. Caroline, did you have something else?
I was going to ask a cheeky one. So if you've invested and you're not making a profit yet, can you still claim capital allowances and park them for when you do start making a profit?
Yes. Simple answer is yes. Your capital allowances would sit as a credit on your account. It has no expiry date on it. And as and when you come into profit and you have a tax liability, you'll just burn that up as and when it's due. The only issue that we have with that, and again, just transparency, if we do a piece of work, then that's going to generate an invoice. We charge, I don't know if I explained it in the presentation, we charge 5.5% of any unclaimed allowances that we can put into a report that you're going to get tax relief from. That is invoiced once everything's completed and everything's submitted off to HMRC. If you're not going to be paying tax for 2, 3, 4 years, or even just for 12 months or so on, you'll still have an invoice coming from us. So you'll have an invoice due for tax relief that you might have a couple of years down the line. So it's that balancing act. And again, our accounts will talk you through how your tax relief is going to lay down, but it's making people aware so that because sometimes people think that they're just going to get a rebate. And if you've not been paying tax in the first instance, you can't get a rebate on something that you're not paying. So yes, you can get the tax relief. And as I say, it can be in a year or it can be whenever your tax liability comes due. But as and when we complete our work, that's when we sort of shake hands and issue paperwork. 60-day payment period and so on, sort of standard practice for payment. But it's always that sort of balancing act that if you're not going to be paying tax until the future, is it worthwhile doing something like this? The only challenge that we've got with furnished holiday lets, it's kind of brought it to a point where if you don't do it now, then it's gone. So regardless of whether you're going to be paying tax now or in years to come, if you don't get it processed now, then it's just lost. So there is that sort of question to ask. But yeah, just as I say, to circle round to your question, no expiry date on it. It just sits on your account. And as I say, if it was a limited company, it sits on the company's account and it reduces their corporation tax. If it's an individual or a husband and wife or a partnership, it sits on your own personal tax. And then as and when you have tax due, it will just sort of burn it up until it's used.
Thank you.
Okay.
Thanks, Ronnie. We'll just have one more question if anybody has one. Well, we've got Ronnie here. Nope. Okay.
Ideal.
Thank you very much,
no
Ronnie.
curveballs then. So no questions that I need to say, I don't have a clue. Let me go and ask someone and I'll let you know. So no, that's ideal. Now, listen, I appreciate everyone coming along and having a listen as well. So that's been ideal.
Thank you very much. As I say, this is recorded, so I will get it up on the Members Hub maybe likely tomorrow, and you can watch again if you want to, or let somebody else know that they should. Thank you, Ronnie. Thank you very much, everybody, for coming. Goodbye.
Thanks a lot.
Thanks. Bye.